Hi, everyone. My guest today is Michael McCloskey. Michael is the founder and the portfolio manager at Greenskeeper Asset Management, which is in Canada outside Toronto. Michael, thanks for coming on.
My pleasure. Thanks for having me, Scott.
We actually met at the Daily Journal meeting. I think it was 5 years ago.
Okay.
How long have you been going to that?
Well, that was the only time I've been there. I mean, I remember that we had a sushi lunch after is what I remember.
Yeah, it was fun. We all got drinks and we were yucking it up at the table.
Yeah.
There was about 15 of us. And it was the highlight of the trip for me.
That was the only time I've ever been there. And I wanted to do it because, I mean, Charlie was probably 94 at the time, and I had heard about it. And what really, the reason I went was the year before, somebody actually took a video of him after the official part of the meeting where he just sat down and gabbed for an hour and a half, and it was awesome. I mean, it was pure Charlie, no filter.
Oh, that's cool.
And so I wanted to get out there. So I went out and with a buddy of mine, Dan, and I think I probably met you through Jake, who I'm going to see next week in Omaha. So yeah, I guess the value circle is pretty tight. But yeah, that was a fun meeting. It was different because it was smaller, so much smaller than Berkshire, which is a circus.
Yeah.
That you could actually be in the room and I mean, you knew a lot of people there too, so it was fun.
I wound up going the year after I met you, and I'd stayed late, and I actually saw Charlie leaving, and I had no idea he's a very large man, and he had this huge walking stick, and he got this momentum going, and I actually had to kind of skip out of the way so he wouldn't collide into me.
He probably couldn't see you.
But he looked like he would beat me with this, 5-foot cane he had. It wasn't
for a second.
It wasn't an old man cane. It was a cudgel. It was like what they had in England around Robin Hood time. It was really quite a sight to behold.
He would not hesitate to beat you with that stick if he were
No, and he just kept going. I mean, he just had this head of momentum, and if he'd stopped, it was like he wouldn't be able to start back up again.
I hope you said hi at least.
I didn't say anything. I barely even looked. I didn't even know it was him. I just saw this guy walking in this strange way, and then I kind of skipped out of the way.
Charlie Monk.
Yeah.
That's fantastic.
So I'm going to Berkshire next week on your recommendation.
You will not be disappointed.
All right. And I should fly in. I haven't booked my ticket yet, but I should fly in Thursday or Friday.
Well, I would come in Thursday. I mean, one of the guys I'll introduce you to, Matt, throws a barbecue, and it's just the more time you spend there, like to me, I started going to the meeting. I've only been there 5. I think this is my 6th time. I started going on my own at the beginning, and then I went with people. But as the years have gone on, I've gotten to know more people. The best part about it isn't the meeting itself, to be honest. I mean, I love hearing Warren and Charlie talk. It's everything else around it. It's these informal events where people are just getting together, and you're seeing people from all over the world that share our view of the world of investing. Mm. And so you just have these amazing conversations and friendships and people that you want to stay in touch with, but life gets busy, so you don't get as much time with them, and these are great places to just get together and chat with people. I remember meeting a stranger in the line of a barbecue 10 years ago, and I still remember the conversation. He said, "What do you think of UPS?" And I'm standing in the line with this complete stranger, and he said, "Do you split CapEx?" Like, it's a geeky question, but it's our kind of people,
right?
And so I think the more time you spend there, the better. I'm happy to introduce you to people there, Scott. And you just got to balance that with our own quirks in terms of I get exhausted being around people, and I think you do too. So, I think you'll like it more and more the more you do it. That's been my experience with some of these conferences. Is the first few are painful for somebody with my personality because you don't know anyone and it's really awkward. But once you know people and you like them and you have these connections, it's fantastic. I actually look forward to
it. So what other ones do you go to? You go to Berkshire. Is there any other one that you like even half as much as Berkshire?
Guy Spear runs a conference. They started over a decade ago called ValueX in Switzerland, and it's by invitation only. Mm-hmm. But it's starting to spread. Like now there's a ValueX in Dubai that I've gone to once, and I'm going to go again this year with my daughter. Vitaly Katznelson in Colorado. I haven't been to his, but there's a ValueX there. And it's a different kind of conference. Like I've gone to some of these traditional conferences put on by the brokers where you have formal speaker up there and you're mingling a little bit. And I personally, I don't love those. Mm-hmm. These are more conferences where the real discussion happens after the presentations, where there's short presentations and then you're talking on the slopes or in the bar and you know, you're meeting these people that I continually stay in touch with, whether it's through LinkedIn or WhatsApp private chats. And I have calls with them from time to time on stocks. So these are people that you can talk to that aren't necessarily in your own market. So they're not really competitors. Mm-hmm. And if someone's got a problem or saying, you know, I'm looking at this research, what do you think of Bloomberg versus Cap IQ? Or has anybody look at this stock? I mean, it's really a forum where, you know, it's people that you trust and know and you build some goodwill with, that you can share ideas. And the rules of these conferences are everything that we talk about is confidential, so you can't get into it, which makes it a safe space to really share ideas. And it's, to me, that's the best part about it. And I really enjoy that. So I don't really do the conference circuit other than Berkshire and ValueX. Those are my two go-tos every year.
It is interesting how uncompetitive people are in value investing. It's sort of like, it's like golf, right? You're not really, when you go out with your friends, you're not playing against your friends. You're just playing against the course because it's so difficult. The whole thing is just so insurmountable and hard. And investing is far harder. It's almost
you're
like
against the world, not just the
you're
people in
competing
your group.
against you're competing against the world, which is just constantly trying to crush you.
So why do you think that that people are willing to share? I have my own theory, but I'd be interested to hear your view.
Well, one, I think people genuinely are interested in just sharing. I think there is a genuine interest. They feel a certain way, and they just like to communicate to other people.
Yep.
And there's no reasoning behind it. They just like to do it flat out. But then also, it's a way to check whether you're crazy or not.
Yeah, so you get something out of it. Yeah, you feel validated when you're talking to someone else. I think part of it is, well, this is just my opinion. Like you said, it's people like to share ideas, and it's just part of the human condition. But if you're talking to like-minded people, a lot of what we do, we can't talk to most people about.
Yeah.
I mean, we can talk about stocks at a high level, but it's like that guy I ran into, a complete stranger, talking about splitting CapEx, you know, growth versus maintenance cap. Like, who does that? We do, but we're weird in that, you know, we're hardcore investors. And so when you find somebody else that you can talk that language to, I think it's that connection where part of what we do is pretty lonely. And you know, I like it, but there aren't a lot of people that you can go into that depth with. And I think another part of it is just when you look at Buffett and, you know, Graham before him, they've just been so willing to share openly about what they do, and they've been so generous that I think it's part of that. And so value has just become, and just, I think the way they interact with the world, they're just so generous. They're givers. Mm-hmm. That I think that kind of has played a role in the community being that way. So I love the value community. I mean, I've met so many great people that have been more than willing to bend over backwards to help or share with nothing in return. And I think it's a great way to live your life.
It's interesting how small the community is. I've heard, I think it was Lee Lu who said that maybe 5% of all assets in the market are managed by true value investors. And I've got to say, I think that is the right number. There's obviously a huge number of hedge funds or mutual funds. I think something like 40% of mutual funds call themselves value funds. But when you look at what they actually hold, it's just, it's closet indexing. It's a very tepid, watered down version of value investing. And they're just basically glorified asset gatherers. But when you look at the actual community, there's very few people. I live in the Gold Coast of Connecticut, and I think I've met one other value investor in the 4 or 5 years that I've been here. Probably half the people in this town, I live in Darien, Connecticut, work in finance. And I meet hardly anyone who's a value investor. It kills me. I feel so lonely. I knew more people in Los Angeles. When I lived in freaking Los Angeles, I knew more people who were value investors than I do here. And it's extremely lonely. It kills me. I feel like I have no one to talk to about this stuff. And sometimes I try, I'm like, well, let me just force it a little bit. And I get this glazed look that comes over people's faces, and then I resent them for it.
Yeah, don't do that so much.
Yeah, so now I have to stop sharing. I have to stop being me.
Well, I think the big cities, the big finance cities, it just doesn't attract value types, right?
No, it doesn't. Why doesn't it?
I've worked in investment banking, and so we worked with we were an employee-owned shop, so I know that the adrenaline that exists on trading floors and sales desk and investment banking, and even the people that it attracts out of school, I think it attracts people that are just very aggressive, and they have this view of what investment banking or trading is, and Hollywood perpetuates that. Whereas value investing isn't that sexy, right? Like it's more rational, it's calm, it's reading, it's about patience, and I don't think most people have the right temperament to do it. Sometimes you have to wait years or sometimes decades for the when it's out of favor. So I just don't think most humans are wired to be value investors. And go ahead.
Sorry, just real quick. I've never heard anyone frame it in terms of aggression. But that is no value investing or not. But I do think there is a lot of aggression in a lot of other investment styles.
Well, absolutely.
And there oddly isn't. It's a very passive, patient aggression in value investing.
Robinhood has built a business model on, that dopamine that people get with the confetti and trading. And I think that's the natural state for most people. And social media is a, validator of that theory, that people are short-term in their thinking and they want that immediacy of reward. And that's not what value investing is about. And I think people that come, you created the Dakota Funds, grew up in South Dakota. I grew up in the suburbs, and the name of my firm, Greenskeeper, is because it was Tweety Brown that said value investing is about as exciting as watching grass grow. But did you ever notice how much your grass grows over a week? It's not supposed to be sexy, and it's not. So if that doesn't appeal to you, if you need that excitement, it's not for you. And I forget who said it, but when you read The Intelligent Investor, which is a hard read, it's not my favorite book.
Mm-hmm.
But if you read it, it either makes sense right away or it doesn't. And I think what that really shows is it's about temperament. You either click as a value investor immediately, or it's just you're not wired for it. And I don't think most people are wired for it personally.
It's interesting. I didn't even know what value investing was, and my dad had told me to read The Intelligent Investor and all those books, and I sort of skimmed them, and I would see, I think he was suggesting buying things at a PE of 5, and I couldn't find anything. I first got into investing in 1998.
Okay.
And I couldn't find anything at a PE of 5. It didn't exist.
Yeah.
And so I would start going through the Wall Street Journal and look in the back, and you could see the PE ratios for stocks, and I would just blindly buy the cheapest stuff.
Wall Street Journal hard print quant.
Yeah, and but it's funny, that really is that's sort of my emotional default. Is I just, what does everyone hate and what don't they like, and it's evolved from there. But where did you start? What was the very first thing where you thought, oh, maybe I'm a value investor, even though you didn't know the term at the time?
So when I was an investment banker, I covered the financial services sector, and there was an analyst, financial services analyst named Jason, was one of my partners. And he had the Berkshire letters in a binder on his bookshelf. And I had heard about Buffett, but I never really knew. Like, I was a lawyer, like you, I was trained as a lawyer. And so I've always loved the stock market, but didn't really know what I was doing. And when I stumbled on that letters, Jason said, well, you should also read The Intelligent Investor. And that was it. I read it. I had that immediate connection that this is logical. I studied math in school. And it just kind of clicked for me. And I just went down that rabbit hole. And for years and years now, just reading more and more, and then started investing my own money. So I fell into it, like I don't know how else to say it, that it was just serendipitous that I met Jason and that he pointed me that direction, and I gravitated towards it.
That's interesting. For me, I noticed even when I was a kid, I liked things that didn't interest other people. I liked to go to places where other people weren't. Like I like to, my friends and I would go, I lived in Sioux Falls, South Dakota, and they would be building huge sections of the city at the outskirts. And we would go to the outskirts of town and go play. And it was like we'd plan construction sites and stuff like that. And we liked to go to places where it was like we were exploring places that didn't interest other people. And that was, and also noticed I liked people who other people didn't like. Like I just noticed that there were people in life who had sort of been, not that everyone disliked them or anything. They'd just been kind of looked over. People that hadn't seen them. And I liked those people. And so I noticed that there was something when I was younger where I was just a little bit different from other people. And it hurt. I didn't like it. I didn't want to be that way. I thought it was weird, and I just wanted to be normal. But as I've gotten older, I love that. And I find with a lot of value investors, there's something a little odd there, and there's something different there, but it's a good thing.
The first time I went to ValueX, I remember, I think it was Guy stood up and said, welcome to the land of misfit toys. There was this old cartoon, Rudolph the Red-Nosed Reindeer, where all these toys were on an island.
I love the island of misfit toys.
So we're all quirky, you know what I mean? And I think to be a value investor, a part of it is not caring what everyone else thinks. I mean, you want to bounce ideas off something, but Scott, I can respect your analysis and you can respect mine, but we can come to completely different conclusions on something. And you have to be comfortable with that, not looking for that outside validation, and being comfortable going against the grain, because stocks aren't cheap if they're popular, right? So the things that you and I are buying have been thrown in the garbage by everybody else a lot of the time. And so I think you have to have part of that in your personality to be good at this. And as you said, like I was like you as a kid, very awkward, didn't have a lot of friends. But as I've gotten older, like I like who I am. I know I'm weird and quirky. That's who I am, and it makes us unique. But it also gives us a unique skill set that is helpful in capital allocation, in my opinion, rather than, I try and work away from other people because you don't want to be influenced, right? Which goes against how I think humans are hardwired, to be doing things that are popular or talking, going with stocks that everyone else is talking about. That's not what we do. So I think it's important to marry your investment style with your personality and who you are. If you love the idea of being a value investor, but it makes you uncomfortable a lot of time, it's not going to work. There has to be that alignment.
So you developed an interest in value investing. What was your next step? You're an attorney and then a banker, and then
I was a lawyer for about 7 years and then a banker for almost a decade. And then while I was an investment banker, I started managing my own money and buying things. We were a small shop in Canada. Our financing industry is dominated by junior resource stocks and energy. And I covered the more staid industries like financial services that didn't really finance much, but I got to learn a little bit about those businesses. So I just started managing my own money. And I remember coming down to Florida on vacation and reading Canada Bread. I remember reading their annual report. And I remember being in an airport and one of my business partners, Brady, came up to me at the airport. He just saw me there. He says, "What are you doing?" He was just being a jerk, and then saw that I was reading a 10K. He looked at my wife like, "What's the matter with this guy? He's on vacation." I'm like, "I don't have a lot of time to invest." And so that was kind of the time for me. I was getting tired of being in, the go-go investment banking business. And I just said, maybe I should do this full time. And so I started managing my own money, took a year off. And then my brother and sister gave me some money, and my mom and dad, and then some friends. And so I said, okay. So I created a fund so that my friends and family could come along. And it's grown from there.
So you were about 40 years old when you started your own fund.
Just over 40, yeah. That would have been, So I'm 53 now. That was 11 years ago, so 42, yeah.
Oh, that's interesting. So you started out, and you'd been investing on your own for about 10 years.
11 years now, yeah. Yep.
Okay. That's interesting. Walter Schloss has some quote where he's sort of like, the first 10 years of managing money are the worst.
Oh, really? I haven't seen that. Yeah, Walter... I haven't read much about him. I know who he is, but is there a book on him?
I don't know if there's a book on him. There's not a lot on him. But
the thing I love about Walter, I love the line, is he was very tight with expenses, And, one year he added his son as a partner and he added a second filing cabinet. And then like that was his CapEx for the next decade. It was fantastic.
I love that. I remember reading an article about him. I think Toby Carlisle wrote it. This is over 10 years ago, but he was sort of like, he'd written something about Walter Schloss. And then at the end, he was saying, and we really appreciate his gentlemanly approach to running the office where he'd leave every day at 4:30. That's
a little poke.
No, he meant it. He meant it in a 100% positive way. like this guy's got it figured out. He's got a good lifestyle. He's doing what he needs to do.
Look at his returns. Leave the man alone.
Yeah, the returns are amazing. Yeah. But so that's interesting. So it really snowballed from there. How did you manage having kind of this asocial personality where you like having lots of time alone with raising capital?
I struggle with it. I struggle with it to this day.
Me too.
I said to my assistant this morning before this call, I said, we need to find more ways to free up time for me. And so when I started the business, my own money and family and friends, I was 3 million of AUM. I was tiny. And so you do everything yourself, right? Because you got to keep your costs down. You don't take a salary. And I was fortunate that I made some money in investment banking that I could do that. Mm-hmm. The downside is that you do everything. I still describe my role as I'm the chief dishwasher at Greenskeeper. So, we're tight on expenses. But as the business has grown, you have to add people. And I added an assistant 6 years ago now, and she's been a godsend. Hi, Michelle. And then this year, I always had summer students come in. The last few years, I've had 8 summer students. Mm-hmm. And one of them who worked for me last year, Michael's terrific. He's joining us full time in June. Mm-hmm. And so you just add pieces, technology. You add software to try and free up time. But how do you do it, Scott? I don't know. I still struggle to spend as much time as I want to on the research side, which is mm-hmm. where I love. But it's so time intensive, and then you got to run the regulatory side of the business, the marketing side with clients, the admin side. There's just a lot of balls in this business, and I read an article the other day or maybe it was a blog. Someone talked about why firms fail. And like Munger, you like to invert, right? Like figure out what they're doing wrong. And the author's view was firms don't fail for performance. It's just the fund manager, he or she can't keep on top of all of this, or they just blow up emotionally or psychologically because they can't balance those things. And look, I do the best that I can, but like you, I don't know that I do it well. I still wish I had more time on the research side, and it's just a daily battle to continue to get better at that is time allocation.
Yeah. I suck at marketing myself. It's terrible. It's something I really struggle with and probably don't spend enough time on just because, I don't know, I actually really enjoy talking to people, but it's hard to put yourself out there. And I've never gotten anywhere by emailing people. It's always people reaching out to me.
In my experience, starting so small, I used to spend more time on marketing in the first 3-4 years because you want to grow the business, right? And it's not a viable business when it's small. And now that we're bigger, I spend less time out there pushing. It's usually inbound where I like to write like you, and I know you're an author. You love to write. And something that I took away from Vitaly Katznelson is just, I don't write as often as he does, but if you enjoy writing, it helps clarify our thought process, put it out there. Mm-hmm. And sometimes people will find you. I get calls out of the blue sometimes from people that they've read something. I got a call tomorrow morning where I just put out a letter yesterday and the person signed up, I think a quarter ago, and then reached out to me via email. So that could be a way of marketing for people like us that don't really love the dog and pony show or being out there. Mm-hmm. But I'm also contemplating putting a full-time salesperson in place, and my brother does it with me part-time too, because he's my opposite personality-wise, where he can walk into a room and own it, and he's in sales for a reason. I'm never going to be great at sales because I don't like it, so I avoid it. Right? I think that's part of it.
Well, that's good that you have him, that you have someone totally different.
You got to recognize where your blind spots or your weaknesses are and complement them, I think. We're not all good at everything.
I'm curious, By the way, I'm home alone right now, so it's raining outside. I've got the house to myself, which I love.
You're
It's
talking to me?
well, yeah, I love that. This is great. But it's really funny. I jumped a moment ago. It's because every so often I hear these weird noises in the house, and I was about to turn around and look out, and I was like, oh, I just need to look in the camera to see whether someone's opening my door or not. But it's very creepy. It's like being in a horror movie. I'm waiting to see if someone's going to open my door. No one's here.
Someone
But,
cleaning out your house downstairs?
Yeah, I guess. I'm always wondering if someone's going to wander in. My dad likes to wander over too, so you never know if he's creeping around the home, touching things with his long, spindly fingers. But so I'm curious. Would like to talk a little bit about your investment philosophy. Just looking at some of the things you own, and I believe you own Disney, UPS. Do you still own those? You've owned them.
Have owned in the past. No, I don't. I don't own either one of those today.
Do you own Express Scripts? Or
It doesn't exist anymore. So
okay.
I did, and it was acquired by one of the insurers. Like Cigna bought it, but I did it at the time.
Okay, and you've owned Visa?
I still own Visa. I love.
And you
Visa.
still own Visa. So those are extremely high percentage businesses. Would be how I'd describe it. How do you think about it?
So just to make sure I understand your question, when you say high percentage businesses, that these moats or just high quality business models, is that what you mean?
Just something where you could look your children in the eye and say this business will exist in 10 years.
Yeah. Okay, I would agree with that. So then I go back to moats, the concept of sustainable competitive advantage. One thing that I like as an investor gravitate towards is free cash flow, or owner earnings, as Buffett would call it, but it's pretty close to free cash flow without getting into all the minutia. So yeah, I think it's safer, and maybe that's part of my personality, that I'm fairly defensive, and maybe I went to law school for a reason. I usually look at the bad side of things versus the upside. Some of these businesses that are trading on 50 times revenue or astronomical valuations based on what's going to happen 5 years in the future, I guess maybe I just lack that vision. And so I prefer those businesses that have been around, that have been proven, that I know that they're good, that I can identify. I mean, Visa, I bought it, I don't know, maybe 7-10 years ago. I can't remember exactly when. I've never sold it. And when everyone was talking about buy now, pay later, disrupting them, or some of these peer-to-peer things, I thought it was slightly cheap. It was never dirt cheap. It rarely gets dirt cheap. So I added more. I think Visa is going to be around for a long time when you really understand the business. So those are the types of businesses, the lower risk businesses, that I tend to gravitate towards. Now, I'll buy something that's a deeper value on occasion. I have a few things or at least one thing in my portfolio that's, I would say, is deep value. But yeah, I don't know why. Maybe I'm just a chicken. I'm thinking about preservation of capital, and I always go back to, in the 80s, Buffett used to talk about the inevitables. I think he was talking about Gillette at the time, where that business is going to continue to exist. And what's funny about Gillette is you've seen people like Harry's and some of these Dollar Shave Club come out, and even their moat has started to erode somewhat, even though Gillette doesn't exist as a standalone today. But I guess I've just taken to heart what he and Charlie have always talked about, is just buy those amazing businesses. And I think it isn't difficult to identify them. It's hard to buy them cheap.
Yeah, very hard.
That's what you got to do. You got to keep turning over rocks. And maybe you find something that's emerging where you can see that it has all the attributes that it's going to become the next thing. But look at Facebook. I mean, I didn't buy Facebook at the IPO because you couldn't see it in the numbers. And I couldn't get my head around, well, if I can't see it in the numbers, how do I know what the business is worth or going to be worth in 5 years? Can they monetize it? And yet I have owned Facebook subsequently, because then I saw it in the numbers and I could recognize the network effect and how good a business it was. So maybe you got to stay within your circle of competence. And some people have that vision where they know with a high degree of conviction where it's going to go. Maybe I struggle with that. So I just try and be honest about it.
That's interesting. Buffett talking about inevitables for me was one of those game-changing concepts to come across. because it's just it makes such intuitive sense if you can find something that just has that amount of staying power. And it's very hard to find. It's something you never. I would say maybe half the stuff we own would be something I'd describe as an inevitable. It's just so hard to find something that meets that high standard, where it just has that high amount of survivability that you can actually get at a good price. But it is such a powerful concept.
It is. And I would say the pool of companies that would meet that criteria, not forget about the valuation, just the number of amazing businesses, it's not that big. Like it's, is it 100? I don't know. I don't even know if it's that high. And then if you can buy them cheap. So that's why, in our portfolio, we own things that are good businesses, but they're not the best of the best always, because rarely can you find them both good and cheap. But, capitalism's brutal.
Yeah.
And it's hard to find those things that have true staying power, because even businesses that have been around for a long time have been destroyed by changes, whether it's the internet or something else.
Well, that's interesting. Munger also has something where he was talking about all these great businesses in his day have been disrupted. So they're looking for inevitables, but the fact is it can change over time. Kodak was a great company in its heyday, and everyone thought Kodak would just exist forever, and then it didn't.
I think the lesson in that, Scott, or the lesson that I try and take away from it, is any business can potentially be disrupted when things change. And so you have to be constantly vigilant. Look at one of our larger positions today is Google. And so, could their search dominance be disrupted by this chat GPT? Yeah, it could. I mean, I don't think it will be, is my current conclusion. I always reserve the right to change my mind. But I'm looking at it, I'm watching it, and I'm thinking about it. And I think you can't just, mentally say that this business can't be disrupted and ignore it. Because maybe it can't be disrupted, and you got to constantly read and think and learn. Those high returns, people are going to come after your profits, and if they can get at them, they will.
I'm curious, when you look at valuation and when you're buying something and what you think you're going to earn. I noticed in your most recent investor presentation, the average free cash flow yield of the things you own today is 6%.
I think that was at a year end, about that.
Okay.
Yep.
So 6%. And so let's say you're trying to target a 15% return. Let's just pick that out of a hat. So that would mean basically a 6% free cash flow yield. You're targeting something that's going to grow, say 9% a year. So that 6 plus 9 gets you to 15, the free cash flow yield plus the growth rate.
Unless there's extra cash or extra assets on the balance sheet, but yes.
Yeah, exactly. Just as a rough shorthand. Are you sort of saying to yourself, look, I want to get, I'm going to buy this at a good or a reasonable valuation, and basically I'm going to earn the free cash flow yield plus the growth rate? Is that how you think about it? Or do you have a sort of a different kind of mental framework?
Oh, that's about right. I mean, I try not to make it too complicated. I do a basic 5-year DCF. I look at the exit multiple of what I think is reasonable based on history. And I want to look at what growth rate I think is reasonable. You want to have various levels of conservatism built in. And you nailed it. I want to try and target a 15% return. So sometimes you'll get it through multiple expansion. But the preference is to get it from the business, right? The free cash flow yield plus the growth. And so, if you can find things that give you a 15% yield. Now you're backing into the, how you can get 15% from my year-end number. I wasn't buying a lot of these things at the year-end value, right? So some of them may have already appreciated at year-end. But whenever I'm trying to buy something, I'm looking for that 15% return. My preference, Buffett always says, get it from the business and not the market. Anytime that you need a multiple expansion to get there, to me, it's riskier because you can't control that. Whereas if you can analyze the business and say, free cash flow yield, plus the growth in the business should get me there, or you can, dividend yield with a bit of multiple expansion. There's different ways to look at it, but it should scream cheap. Some of my best investments have screamed cheap, and that's kind of how I do it. I don't have a way that's always the same. I mean, I always try and do that 5-year model, but every investment's different.
Mm-hmm. It's interesting. My kind of default is to go for things that are more towards the cheap end of the pool. But as I get older, I have greater and greater respect for the way you're doing it. And there's two reasons behind that. One is the lower risk, is the lower business risk.
Okay.
That would be number one. And number two is it's a less cyclical way to manage money. Where if you look at deep value, for example, deep value is sort of value. It's like high beta value, where if value goes out of favor, like it has for the last 10 years, deep value goes way out of favor. And, we're not buying garbage businesses like a lot of deep value investors. We're buying better businesses, but still stuff that are scary situations in a lot of cases. But it's the sort of tracking error, the volatility of it is higher than what you're doing. And I notice with people who have a similar approach to yours, where they're really trying to get the business to do most of the work rather than quote unquote playing the market, it isn't as cyclical. Your returns over the last 10 years have been very good compared to most value investors, and I suspect that's because you're in higher quality businesses.
Yeah, it could be a function of the market. Yeah, it's funny you say that. I mean, I think my returns have been okay. I'm never happy, which is why I like this game, because I think I can do better and I want to do better. But if I go back in time, Scott, I'd say 11 years ago, I was probably closer to you. I've never been deep value, but I was probably more concerned about buying things at 10 times earnings.
Mm-hmm.
And you're never going to buy these at 10 times earnings. And, if you can get it at 20, given its growth rate, maybe that's a good bet. So I think it comes back to, I agree with what you're saying. Growth of the business, if you get the business right, the intrinsic value compounds in time. So time is your friend. If you're deep value and the business is mediocre to bad, Mr. Market has to save you. You may be buying it dirt cheap, but if, I own one of those things in my portfolio today and it's down from where I bought it, I need the market to re-rate that stock to have a good outcome. And I've owned it for 2+ years. I still think I'm going to get a good outcome. But if that good outcome doesn't come for 10 years, then my return is going to be terrible.
Mm-hmm.
If it comes this year, it's going to be great. So that's the old expression, I don't know if it was Buffett or Munger, that time is the friend of the great business and the enemy of the bad one. So I like the fact that the growth in the intrinsic value kind of saves you. Because if you buy something, and even if the market doesn't recognize it, the business is continually worth more, and someday the market will recognize that. So that's kind of why I've gravitated towards that way. But maybe the market's going to come your way, where deep value's back in favor. We've also been in this low interest rate environment for a decade. That maybe value's been tough, and maybe that's going to change. I don't know.
Well, it's interesting. It's funny. I've really gone away from. When I first started my career, I was willing to buy stuff that was a melting ice cube. Mm-hmm. And boy, that I would never do that.
I've done it
today. I just don't, it's just too much. And in fact, we don't even buy stuff where we think it's just maintaining its intrinsic value. We want something where it's growing.
Yeah.
If we can get that. And it's because it's so painful to not have that. If you don't have that compounding, it's exactly, you run into the teeth of what you just said, where time is not on your side. And that's a very difficult position to be in. You need to be saved at a higher valuation.
I think the deep value can still work. I mean, I don't do it, but there was someone who showed me some analysis recently where it was quant, where they bought, I can't remember the number, 30, 50 stocks, and they would rebalance every month or quarter. And the back testing showed that it works. The problem is you're so reliant on the market that you got to do it as a basket. Like, you have to have a lot of names to do that. If you're in a concentrated portfolio, or even a portfolio of only 20 names, and you're doing it from the bottom up where, okay, fundamentally it's cheap, I think the returns were good, if I remember the study correctly, that it was because some of the businesses would fail, some would do okay or remain fine, but a few outliers would earn so much that as a basket, the IRR would be quite good. So I think that might be another way to come at deep value, is just doing it quantitatively, because maybe you're taking the the event risk is a wrong word. The market needs to recognize it. So you need a portfolio where those few winners save you, but it's almost impossible to figure out which ones the market's going to recognize over any period of time. So maybe that's a different way to do it. But it's not for me. I prefer to have those growers because, again, maybe I'm just a chicken and more conservative.
Well, it's interesting. I think deep value definitely works. And we put together a database of great investors, and we found that a third of them were deep value investors, which is shocking because there are so few deep value investors. There's almost no mutual funds that are deep value investors. There's maybe, I found in all my searching, I found maybe 2 or 3.
How do you market that? We invest in terrible businesses, but they're cheap.
Well, I think what happens is they're not necessarily in terrible businesses, but they're in stuff where they're investing around the world, and there's some issue that happens where they're able to get it at 5 times earnings or 7 times earnings, and they're or they're in cyclical stuff, and it's not making any money, but they think the cycle is going to turn. So I don't know that I don't think it's like they're buying Best Buy or things like that. I think that's a more uncommon. The cigar butts I think are actually not that common a feature of deep value strategies.
Interesting. I didn't realize that. Okay.
At least, and with a lot of successful investors that we looked at who were in our database, they were not buying something that was just going to go out of business in 5 years.
Okay.
And they just thought they could extract, make a 70% free cash flow yield until that day. That was not Buffett's characterization of it that way was relative. It wasn't totally rare, but it wasn't the most common type of investment. It was a smaller percentage of that than I thought. But what I like about your strategy is that I feel like investors have to, they can trust you less. Where if someone has a strategy that's swinging all over the place and you're down 20% versus the market, that's a pretty scary thing. And people say they're not going to freak out, but they do. Whereas with what you're doing, you're investing in stuff where you have so much confidence in it, and it's such a high percentage business that you don't get those big swings. And as a result, investors, they don't have to trust you as much. They don't have to you're not requiring such huge leaps of faith to continue investing with you. And I think that's a real virtue. And I'm curious how that strikes you.
Never thought of it that way. Yeah, maybe you're right. I mean, I sleep pretty well at night, so hopefully my clients sleep pretty well at night, knowing that Google should be fine, Visa's going to be fine, Berkshire, which is our biggest position, is going to be fine. I don't want to have to be so stressed out that, oh my God, what's happening this quarter? Mm-hmm. Did the company blow up or did they miss by a cent? Like, I don't really care. I want these businesses to continually earn more money, to continue to buy back their stock or pay us dividends. And I don't want to have to be on top of it every single second. I don't think that's good. And I want to be able to compound capital without trading in and out of names. Our turnover has been pretty low over the last 11 years. So I don't trigger tax. So I don't know, maybe I've just married my personality, Scott, with how I built the portfolio. And these are names, part of it is just names that I'm comfortable with. Go back to Peter Lynch, things that you see in your day-to-day life that you're familiar with. I tend to gravitate towards those as opposed to businesses I've never heard about. That doesn't mean I wouldn't invest in them, but you just get more exposure to the day-to-day. So maybe that's just the opportunity set that I'm reviewing every day. I don't know.
Yeah, that's interesting. It's interesting. When I think about your strategy, to me, sort of a paradigm investment would be like Munger's and I can't remember the name of the fund off the top of my head. It's an English investor, but they both bought it in the early 2000s. Something had happened, and it was basically trading at a 6 to 8% free cash flow yield.
Okay.
And then Munger and this guy in England, Nick
Harry
Sleep.
Smith? Oh, Nick.
Yeah, Nick Sleep. That's who it was. They both bought
Nomad Fund. Yeah.
Nomad, exactly. And it was interesting. But with Nomad, they just basically, for them, it was literally free cash flow yield plus growth rate. And they thought it's going to grow 15% a year indefinitely, which is exactly what happened. And they wound up making, 6 to 8% plus 15%. And so a little over 20% a year on this thing. And is that sort of, would something like that to you be like just your sweet spot where you would just
Yeah.
love to find something like that?
Well, yeah, because the business is going to grow at an amazing rate. If you can have a high degree of conviction that it's going to grow at that rate, then the market multiple matters less, right? Mr.
Mm-hmm.
Market matters less. You can see the intrinsic value growing, and I think it was Munger who said over a long enough period of time, and we're talking decades, the initial price you pay is less important than the growth rate of the business. You can put a 50 times multiple on a business. I mean, I wouldn't pay 50 times, but you could have put a 50 times multiple on a business like LVMH, for example, years ago, and still had a really high IRR, even though the PE came down significantly, just because the business itself compounded so much that you can get an amazing return. The growth will save you or even give you an amazing return if it grows fast enough. So Nick and his partner, I think they're retired now. They made so much money. But yeah, I mean, those are the best businesses where you can just, once you identify it, you monitor, and you get better at monitoring them over time because you learn or get to know the businesses better. But then you can just sit in your rear end and just watch them compound for decades. Those are the best businesses.
So I'm curious, what do you know works in investing? If you died and you went to the pearly gates and I think it's St. Peter. St. Peter comes out, and St. Peter's, yeah. We'd both be lucky to reach this point, but he comes out. He's a real hard ass, and he says, "Okay, what is one thing you know to be true about investing, and this better be right."
I think markets will not change over time. That there's always going to be this swing between your euphoria and fear. I don't think that will ever change. And so I think that value investing will always work. That's something that I believe. It may go out of favor from time to time, but the psychology is almost more important than the math, is just recognizing where we are in the market. To me, that's a truth in investing, and you see it over and over again. So people forget about risk from time to time. We've seen it over the past decade, and last year, they paid the price for that. And I think people that were better positioned, like your fund or mine, didn't suffer as badly. I don't think human psychology will ever change. It's just how people are wired.
So what you're talking about is something I'm obsessed with. This idea that life fundamentally does not change. The furniture changes, the clothes change, the technology changes, but life and the human condition, it's kind of an annoying term, but it does not fundamentally change. Is that how you feel?
I believe it to be true. I mean, read Meditations, Marcus Aurelius, and the stuff, or Seneca, the Stoics, what they were writing about, 2,000 years ago. It hasn't really changed much. Maybe our technology's changed. Human beings haven't changed. Society hasn't changed that much, and I don't think we'll ever change. I think it's innate to who we are, and you can take advantage of that in the market, right?
Mm-hmm.
If you step back and recognize what's going on. That's why I try and read things that are more than 10 years old, more than what's the latest book coming out on a particular subject. I love the classics and all kinds of different genres, just because there's so much wisdom there, and you just gotta go back to the fundamentals. I go to Berkshire every year, not to hear Warren and Charlie, as much as I love that and hear what they say. We've heard it all before in one form or another,
Mm-hmm.
but it just reinforces the right lessons over and over again, and that's what I like about it. So, to answer your question, I don't know if I answered your specific question, but we're never going to change, and you got to recognize that. You have to have that perspective, and if you have that framework, it's helpful in investing.
Oh, I 100% feel the same way. And I had a similar experience. I remember reading Seneca, another Roman, and he was talking about, I read On the Shortness of Life.
Yes.
I believe it was called. And he's complaining about seeking prestige and all these things and how much work you have to do and how awful it is. And I remember reading it when I was 20 too. And I already felt the exact same way. And I was just struck by the fact that this man's life was so similar to my own, and yet he lived 2,000 years beforehand. And it hit me that life really doesn't change very much. That's a shocking thing. I don't think most people are in touch with that. I don't know if they don't think about it at all, or it's just they have no reason to. But it's a very shocking thing to come across. I'm reading Moby Dick right now, and I'm shocked by how relevant his observations about human beings are to people today. It's stunning to me. And it was written in, I don't know, the 1850s.
I've never read it, but it makes sense to me what you're saying. I think a lot of people go through life without ever thinking about these things. I think a lot of people go through life without reading a lot of the classics. And I don't know, it's easier to turn on the TV every night and watch some reality TV show. Whereas a lot of people in our community are readers, right? And thinkers. We just enjoy thinking about these things. And you're a writer. I just find it fascinating. Personally, I don't do it because it's homework. I do it because I'm interested in it. I'm infinitely curious. And so I think there are a lot of lessons just reading these classic books. And you can apply those every day if you're constantly learning.
There is something about when you find something worthwhile that you really believe to be true, just reading it over and over. I remember in The Spy Who Came In From the Cold, John Le Carre's first book, he's talking about counterintelligence people and how they're different from intelligence people. The counterintelligence people, he describes them as just they're like animals chewing on bones over and over to extract every little calorie out of it. And they just chew over this little bit of information they have and over and over and over. And I find that with good writing, with something that's true, where there's definitely some wisdom there. There's something about just constantly rereading it and coming back to it. And I get more out of that than I do out of being exposed to this huge amount of new things. I'd rather try to find something where I'm pretty sure it's right. Yes. And try to get as much out of it. Whereas with most things, like I don't watch a lot of documentaries because most of them are bullshit. Something will come out later and it just, they'll be like, oh, this person's innocent. And there's this whole documentary about it. And it turns out they just left off half the evidence. There's always, that has always bothered me a lot. And so when I find something like Charlie Munger or Seneca or Marcus Aurelius, where there's some truth there, there's something to just there's something to making yourself keep coming back to it and trying to extract more out of it.
Well, it stood the test of time. I forget there's a word for it, but books that stand the test of time and are still relevant today, they've already, that filter, right? A new book that doesn't provide a lot of new wisdom will quickly come in and out of favor, but something that stays in favor for decades and decades and maybe even centuries, if it passes that filter, then it's probably worth reading. You talk about rereading things. So I like analog books. I like physical books as opposed to reading things on a tablet because I'm a visual thinker. And so I highlight and make notes and I put them on a bookshelf. Sometimes I'm thinking of something and I remember a book passage and I'll go to the book like you and look at my notes or my highlights. And on occasion, I'll just reread a book, not head to toe, but just the highlights because it just brings up the rest of the book for me. So I think that's a really helpful practice for lifelong learners is to build that library that you continually go back to. Have that initial filter of, should you be spending your time on this book? Is it worthy of spending the investment time to, it takes hours and sometimes weeks to read books. Just make sure you're reading the right things.
Is value investing imaginative or unimaginative? And does it matter?
It's probably less imaginative than growth investing or VC investing. Does it matter? You got to be right. You got to be right about the future. So you got to be able to see it. And if you're a special person that even though the historical numbers don't show it, if you can anticipate, a startup business, what they're going to do, your returns are going to be better than buying the safer type of businesses that I tend to gravitate towards. So does it matter? Yeah, it might matter to some degree. But if you're not the most imaginative or artistic person, and I'm not, you got to be honest about it. I like to look at hard numbers and and then just think about the business and how it's going to evolve. So maybe it matters, but I think you just got to be honest with yourself about what your strengths and weaknesses are.
Yeah. Interesting. I'm not sure. I have no idea. I don't have an answer to the question.
There's a creative aspect to it.
There is something, it requires belief in something that does not exist today. And that there's something special about that. It's a risk.
But in a business that's changing a lot, I think you have to have more imagination and creativity versus a business that's proven itself over time. You can see the cash flow, and maybe they're going through it. My favorite is amazing business going through a temporary, or the business is hated at the time being for something specific, some event that you think is temporary. Because then you can see the business has proven itself, and then the only issue is this temporary? Is it permanently going to impair or change the business? Or are we going to go back to what was? And I think that's a less risky scenario. You still got to be right about the analysis versus I'm buying a business that, is growing like stink, but doesn't make any money today. But I'm betting that in 5 years, they're going to make a ton of money and grow into their valuation. I think you have to have way more imagination. And for that reason, I think that's a riskier bet. Certainly for me, if you don't have that, grand vision. But I would say in general, I think that's riskier than what we try and do.
Yeah, I do too. I'm curious. I just have one last question for you. Do you think at all about not macro, right? I don't sense you're that into a lot of the macro stuff, but do you think about the bigger picture in terms of, right, the Shiller PE in the United States is 28 or 30. It's one of the three most expensive points in its history. Do you think about those sort of big, titanic risks that are out there, or are you not or do you sort of say, look, I'm not going to focus on that at all?
No, I think about it, Scott, to understand where we are and the environment. I mean, maybe not the Shiller PE, but interest rates. You don't have to know that the market is, exactly where we are in the cycle to know that we're in an extreme fear or extreme euphoria phase and that things are expensive or cheap, or maybe we're somewhere in between. I think that's important to understand. I think knowing that interest rates, from its low point, I just wrote our quarterly newsletter and I said, it's never a good idea to lend your money out for 10 years at 2%. That's always going to be a bad idea, even if it's guaranteed by the government. So I think it's important to understand what is going on macro, because when I'm evaluating from the bottom up on individual stocks, you have to understand the overall environment. How is this going to impact, Alphabet and any business, frankly? If it's a cyclical business, okay, interest rates are increasing, inflation is out of control, but they're trying to rein it back in. Cyclical business, housing, for example, how is that going to be impacted? I think you have to know what is going on at the macro level so that you can analyze the individual businesses and where they're going to go. But I don't make, I'm on a chat where they talk a lot about macro, and it's just too complicated. Like, to say that, well, I think that the Fed is going to stop raising, which is what all they talk about all day on TV, is whether the Fed's going to raise or when they're going to stop. Yeah. So what? Okay, this is generally where we are, but even if you get that right, doesn't mean you know what the market's reaction is going to be. And to me, it's just too hard. I don't think you can predict what that really means, but you can predict if I own a company that's really levered, its interest expense is going to go up, and its risk of not being able to refinance at an attractive rate is going to go up. Or if I own a cyclical business, and the economy rolls over, which it might. I don't know if it will or not. I think it's important to understand that. And one of the things I wrote about yesterday, our quarterly, I talked about all the bank failures that are going on. And in Canada, we kind of skated through 2008 because we never had the shoddy lending practices, subprime lending practices, or fraud that happened in the U.S. market. Mm-hmm. So that was a good thing, right? Our banks did fine. Our market and our economy did better. But the downside is our housing market never corrected. And so Canada has, in my opinion, one of the highest or most overvalued housing markets in the world. And there's been numerous articles on that. And so I've just avoided the Canadian banks. And that doesn't mean that it will happen. It probably won't. Maybe we get a mild correction like we're going through now, but it might. And so I think you have to understand those macro risks when you're looking at individual stocks. And so I do read about the macro and read same thing you read The Economist and all these things. You have to know what's going on so that you can apply it at the bottom up level. But otherwise, I never make a top down call like some of the great fund managers can do that, and it's too hard for me.
That's interesting. There's a Canadian, I believe he's Canadian economist, Reuven Brenner, who wrote a fascinating paper over 10 years ago about the housing market. And he was basically saying that when people don't have enough money to retire or don't have enough money for some necessary financial goal that they that they really need to hit, that basically it's rational for them to gamble.
Yeah.
And he's saying that basically when you look at the housing market in the United States, and I don't know if he was talking about Canada as well, he was saying that basically there are all these people who they were short. There was a shortfall in their retirement savings. And so there was a lot of this activity in the housing market because people were trying to make up that shortfall in their homes, which was not traditionally the home is not a source of capital gains,
yes.
But it suddenly became potentially one. And so people just started gambling. And he was saying that that's what's going on. These people are terrified, and this is a chance for them to actually hit the goal. And if they don't take the risk, they won't hit it. And so that he explained the behavior that way. I thought it was fascinating. And it actually is totally applicable, not just to housing, but to a lot of things today where there's something bad in the economy, and there's just this incentive to gamble.
It's loss aversion, right? I forget who was the Israeli. What's the famous study where when people
Kahneman?
Yeah, Kahneman. So he has a name for it, but it's loss aversion. When you're in a loss position, you will take more risk to try and get out of that situation. Whereas if you're in a gain position, you'll take less risk. So it's flawed to some extent, but it's true. And everybody wants a shortcut, right? People want to get rich quick, and you go back to Munger and Buffett. They always knew they were going to be rich, but they wanted to do it slowly. And I think their poor friend, was it Gurin, blew himself up because he levered up because he wanted to get there quicker. And ultimately it worked out fine for him. But I'd rather take way less risk and just compound decade over decade. And I don't want to go back to back to zero. You know what I mean? So.
Oh yeah.
but if you have no money and you're on what's Robinhood and taking big swings with options, and that's your only shot at achieving financial independence, or maybe I'd think differently if I were in that position. I don't know. I don't like it, but maybe I would.
As I get older, I value quality of life more and more. There's so many things I don't invest in, not because they might not be interesting, but just because they're time consuming. Mm-hmm. And I just don't want to waste my time on something that might turn out to be not. So I'm sort of like, it's too hard. I'm just not going to do it. Not for any seemingly rational reason, but just out of self-preservation.
Our most valuable resource is our time.
It really is. Well, listen, this has been great having you on. This has been a great discussion. I've really enjoyed this. Hopefully we'll connect. We'll definitely connect at Berkshire in a week.
Yeah.
But Michael, this has been great. Thank you.
Appreciate the invitation, Scott.